The Income Tax Act 2025. Today I'll be studying Chapter 4, which is Profit and Gains from Business or Profession, and I'll be covering Section 26, 27, and 28. Before that, a brief overview of what I'll be studying in this chapter. I'll look at the profit and loss account from the point of view of a businessman, and we'll see which incomes we can include in our taxable income and which expenses we can claim allowance or we can allow as expenses. So in expenses, we have sections 28 to 33, 44 to 49, 51 to 52. And all those expenses which were not covered in these sections will be covered in section 34, which is a residual section. And for incomes, we have section 26 and section 38. The remaining will be net profit or gain from business or profession, and it will be taxed. So starting with section 26, which is a charging section of PGBP, and it will include a list of all those activities, the incomes from which will include in under the head of PGBP. So starting, it will include any profit or gain from business or profession carried on by the SSC. Any profit or gain we earn from any business, which includes trade, commerce, and manufacturing, will include that income in PGBP head. And then we have when we export some goods for which we have claimed we export some goods the import of which we paid for the import of which we paid import duty, and then we export such goods, the government gives us refund of the duty we paid on import, and the refund is about 98% of the amount, and that refund we call as duty drawback, and that duty drawback is treated as PGBP income because it's income of business related directly to business activities. And then we have import entitlement license. Let's say a person is KK Limited. He made an export of 100 crore rupees. So the government will entitle him to make an import of 50 crore rupees. But he does not need that 50 crore rupees import. So what he'll do, he'll sell this right to somebody else for, let's say, 20 lakh rupees. This 20 lakh will be treated as business income for that SSC. And we can see the same from the book as well. Any profit or gain from business, any profit or gain from any business. And here is sale of import entitlement license duty drawback. And then we have any gift or perquisite or benefit received due to profession or business, like an example of sir where he said a person is CA and he is engaged in like dealing with his clients, let's say assessment proceedings, and he won the case. So the client is very happy and he gives him something, let's say a gold chain. That gold chain will be due to the business or profession, and therefore it will be taxed under the PGBP head of income. And then we have key man insurance policy. This provision I had already studied in the previous chapter, where when amount is received on majority of a key man insurance policy, if it's received by the employer, it's taxable under PGBP. If it's received by employee, it's taxable under salary, and if it's received under no employer-employee relationship, then we tax it under IFOS. So the amount received on majority of the key man insurance policy, when it's received by the employer, the businessman, it's treated as profit and under the head business income. After that, there is non-compete fees. Non-compete fees can mean two things. Firstly, it can mean for not engaging in the similar kind of business. Let's say a person is engaged in pharmaceutical business, somebody else wants to enter the industry, and he's afraid that and the new player might cut his profits, so he pays him an amount to stay away from the industry and deal in some other businesses. That amount is called non-compete fees, to not compete with him in the market, and that is taxable under the head business income. Similarly, there is another thing called for not sharing of any know-how. It's also included in non-compete fees. An example is simple, where let's say Honda Limited is giving some technical know-how to Hero Limited to manufacture bikes. For this, the Hero Limited is making a payment of 500 crore to Honda Limited, but out of this 500 crore, the 50 crore represents royalty, and it will be treated in some other chapter. And the 450 crore, it represents the non-compete fees, means it is for stopping Honda from sharing this same technical know-how with any other manufacturing company, let's say Bajaj, so that the Bajaj cannot enter the industry with the same know-how. This is fees for not. This is also a form of non-compete fees, and it's also taxable under the head business income. Here it is non-compete fees for not carrying out any activity or not sharing any know-how, patent, copyright, or trademark. After that, there is if a firm pays remuneration or interest to partners, it's stated under PGBP. But this remuneration includes salary, commission, bonus, allowed, which is allowed under Section 35E. It is studied in chapter number 6, not here. And this remuneration is not paid as a result of and this remuneration is not paid under an employee-employer relationship, because a partner is like the owner, is in material in substance the owner of the business and not the employee of the business. So this income, whether it's through by way of interest, salary, bonus, commission, it's received by the partner from partnership firm. It's taxed under the head of business income for the partner. And after that, there is contracts. When two or more persons make a contract and on termination of or modification of the same contract, a compensation is paid by one party to the other. That compensation is treated under the head business income. An example is, for example, Haldiram gave a franchise to Mr. BB to run for 3 years, but Haldiram gave the same franchise to some other person also who is like right besides BB's shop, which will be a direct competition for Mr. BB. This is kind of a violation of contract terms, so Mr. BB sues Haldiram, and after the decision of the court receives a compensation for this practice of Haldiram, and this compensation will be taxed under the head business income. After that, a simple one is stock in trade is converted into capital asset. On conversion of the stock in trade, the fair market value is treated as the business income. Next one will be the clubs. The clubs, as is mentioned in the book here, it means trade, professional, or other similar associations. So let's first understand with an example how clubs work. So, as in this example, let's say 10 people want to go to Goa and they decided a contribution of 5,000 each to sponsor the trip. So in total it's 5 lakh rupees, and on the trip they spend 4 lakh 70,000 rupees, and the 30,000 rupees is surplus for them. This surplus will not be treated as business income because it's really not any income. This is a set of people who are gathering money by themselves and then spending it on themselves, and the surplus from that activity, it cannot be treated as income. This 30,000 they can distribute back to themselves in the proportion of contribution or whatever is not relevant. So when a club makes such an activity, it's for the general service of the members of the club. It's not treated as business income. However, when this activity is done as a special service for a specific member, like let's say Shah Rukh Khan is joining this club and he's also going on the vacation and he wants some specific hotel room or some car or something, some service he wants in excess of what everyone else is, some special service he wants, then that special service for a specific member of the institute, that will be treated under the head business income, because that's like a business. You are working for someone and he's paying you for that. It's written here as well. Income derived by a trade, professional, or similar association from specific service performed for its member. After that, we have normal and speculative businesses. We treat normal and speculative business as separate and distinct businesses. Why? Because the losses arising from normal businesses can be set off against any head of income except salary. So we can set it off against house property, other sources, or house property, other source, or other heads of income. But the losses from speculative business, we cannot set that off with any other head of income except the speculative business income, and we can carry it forward for 4 tax years. So there is a difference in the treatment of the losses of the businesses. That's why they are treated as separate and distinct businesses. What is a speculative business? It's a business where we make like an agreement of purchase or sale, but there is no actual delivery of the goods agreed upon, and there is always something other than the actual delivery. It means a transaction in which contract for purchase or sale of any commodity, including stocks or shares, but periodically or ultimately settled otherwise than by actual delivery. An example can be intraday, where we buy or sell shares during the whole trade, but there is no actual delivery of the shares. And there are some transactions which look like speculative transactions but are not deemed to be speculative. It includes hedging contract in respect of raw materials, merchandise, or stocks and shares. If we expect a rise in price of raw materials, it could affect our business. So what we do, enter into a hedging contract to protect ourselves from the rise in prices in the future. Similarly, forward contracts, trading in derivatives, the futures and options stuff. And then there is commodity derivatives on which CTT has been paid. There is one exception here. In case of agricultural commodity derivatives, even if the CTT is not paid, it's still not considered as speculative transactions because there is no such requirement of CTT in this provision. After that, we have the income from letting out of a residential house property. An important one. Here it is. Section 26, subsection 4. Any income from letting out of a residential house property. The focus is on the word residential house property. It will be treated under the head house property and not under the head PGBP. So the background of this section, we will go to understand this section in detail. We'll go to section 20 of the act, which is the charging section for house property. It lays down only two conditions: that there should be a house property and you should be the owner of that house property. Then any income from that house property will be treated under the head income from house property. This house property may be residential or commercial or whatever. An example is a builder is there, he's making houses, and if he sells those houses in the course of his business, it's PGBP. But if he rents those houses, even if it is in his course of business, it's still treated under the head of income from house property. But there was a case law, Chennai Property and Investment Limited, and it was a landmark judgment by Supreme Court, where this company had in its MOA and AOA that the business is only to acquire properties and to let them out. They had no other sources of income. This was their only activity. And the Supreme Court ruled that this income will be treated under the head PGBP. Here is the case law. Their MOA was to acquire and hold properties in Chennai. Their entire income was comprised of this letting out income, so it was treated as business activity and treated under the head PGBP. But then what happened in section 26 subsection 4, the language was improved and it was clearly mentioned that any income from residential house property will be treated from as income from house property, and this case law, this will be only applicable on commercial properties. So to summarize, a house property will first check if it's residential house property and it's let out, it will always be a income from house property. It doesn't matter if it's in the course of business or whatever, any condition, it will always be HP, income from house property. But if it's a commercial property like shops or renting of classrooms and it's let out business like Chennai business was, then it will be treated under the PGBP head. But otherwise, if it's not a let out business, then it will be treated under the head house property only. After this comes the case of like Airbnbs. This is a clarity concept, not for exams. It if there is composite rent, means rent of house property and rent of other assets is also received, then we'll have to check if the agreement is separable or not separable. If it's separable, we'll treat the income from the renting of house property under house property income, and the renting of other assets like furniture, carpets, and any other thing, AC, or any other thing that is in addition to the house property, that's not primarily the part of house, it will be treated under PGP or IFOS depending upon the circumstances. But if it's not separable, like in the cases of Airbnb, PGs, and hotels, then it is always treated under BGBP or IFOS depending upon the circumstances. A question arises why we are differentiating between house property and PGBP income when they have the same tax rates. The thing is that in house property we have only 30% standard deduction and deduction on interest income. That's it. But in PGBP we can claim deduction of many things covered in these sections, section 28, 33 and section 34. After that is the Delhi High Court case law of K and Company. K and Company was engaged in some business, I think lottery business, and they needed a bank to give guarantee to the government on behalf of K and Company. So for that, the bank not only will charge commission, but it also asked K and Company to make a FD with the bank, and this is an assumed amount of 10 crore rupees. So K and Company, for the purpose of running business, they had to get a guarantee from bank, and for the obtaining the guarantee of the bank, they had to make a fixed deposit with the bank. So the interest of this on this fixed deposit, it will not be treated under IFRS, and it will go under the head PGBP because it's linked directly to the business, or in the words of the court, it is inextricably linked to the business, means it's impossible to separate from the business. After that, there is a small section, section 27. It just says how we compute PGBP income. It's computed in accordance with section 28 to 60, except section 58, which is presumptive taxation, the 6%, 8%, and 50% profit rates. And then there is section 28. Section 28 is the first section among the expenses of allowed for a business. Section 28 deals with the rent, rates, taxes, repairs, and insurance we pay on our immovable properties like premises, plant and machinery, and furniture. When we are the owner of those assets, how will we treat such expenses? We will have no rent, so it's not applicable. The rates and taxes will be allowed, insurance allowed, revenue repairs allowed, but capital repair will not be allowed as to claim as expenses because it will be added to the cost of the assets, and thereafter we can claim depreciation on such assets. Similarly, when we are tenants and we pay rent, that rent is allowed as expenditure, rates and taxes allowed, insurance allowed, revenue repair allowed, but again capital repair not allowed for the same reasons. There is a little point to be noted in this, which is rent is only for the premises mentioned in section 28. Section 28 only allows us to claim expense for the rent we pay on the premises and not on plant and machinery or furniture. But we can still claim the expense of rent on plant and machine and furniture in the residual section of section 34. After that, we have a little clarification on the capital expenditure we incur as tenants. Let's say Mr. Kaka is the owner of let's say premises, and then BB is a tenant, and he incurs expenses of like for 25 lakh rupees on the premises. This is a capital repair expenditure, but if you'll see, he is a tenant and it does not create any asset for him. So how will we treat it? We cannot deduct it as expense in PNL. It's not allowed. We cannot allow it over the period of tenancy. It does not make sense. So there's a concept of deemed building. We'll include it as an asset of Mr. BB and we'll deem it as a building of Mr. BB, and then we can add this as the cost of asset and then claim depreciation on it. For a general concept for many sections in the Bare Act, they have mentioned the word paid, like rent paid, rates paid for this. How we interpret this word, it depends upon the method of accounting followed by the SSC, whether we do it on cash basis or accrual basis. It depends on the method of accounting of SSC. There is an exception here of section 37, which is the section of disallowances, which says we can only claim some expenses only on the payment of such expenses, not when we accrue them. That is it.